Let me guess what happened to you sometime in the last few months. You opened your phone, saw a headline about Micron stock going absolutely vertical, and you did the math in your head. 12 months ago, it was trading under $100 a share. Today, it's a trillion-dollar company, up over 300% in a year. And you felt it, that hollow feeling in your stomach, the one that says, I knew about this company. I literally could have bought it, and I did nothing. So now you're doing what everyone does. You're staring at the chart, trying to decide if you should buy Micron right now, at all-time highs, near the top of a 700% multi-year run, because you don't want to miss any more of it. Here's the thing, that decision, buying the stock everyone is already talking about after the massive run, is the single most common way retail investors lose money in a boom. And I'm going to show you why, but more importantly, I'm going to show you something much more useful, the actual map of where the money flows during a technology build-out stage by stage, so that instead of chasing the last winner, you can start looking where the next one comes from. Because Micron wasn't random. Micron was predictable if you understood the map. Let's build it together. First, let's understand what actually happened with Micron, because the story tells you everything about how this game works. For decades, Micron was a boring, brutally cyclical memory chip maker. It made DRAM, basically the commodity workhorse memory in computers, and its stock went through gut-wrenching boom and bust cycles as memory prices swung around. Nobody was excited about Micron. It was the definition of an unloved stock. Then AI happened, and something specific changed. Every single AI accelerator, every NVIDIA chip powering this entire revolution, needs a special kind of memory stacked right next to it, called high-bandwidth memory HBM. Without it, the world's most powerful AI chip is like a Ferrari engine with a drinking straw for a fuel line. The processor can think incredibly fast, but it starves waiting for data. And here's the shocking part, only 3 companies on the planet can manufacture this memory at scale: SK Hynix, Samsung, and Micron. 3 companies, for the entire global AI build-out. Micron's entire 2026 HBM production is completely sold out under binding contracts. Not partially reserved, sold out, a year in advance. In its most recent quarterly results, revenue grew 196% year over year to nearly $24 billion. That's how a boring commodity company becomes a trillion-dollar giant. It wasn't luck. It was a bottleneck. And that word, bottleneck, is the single most important word in this entire video, so hold on to it. Now, here's where I need to challenge how you've probably been thinking about the AI boom, because most people have it completely wrong. Most people think of AI investing as one trade: you buy NVIDIA, or you buy whatever AI stock is in the headlines, and you hope. But a technology build-out isn't one trade, it's a sequence, a chain of bottlenecks that get hit one after another, and the money floods into whoever solves the current bottleneck, then moves on to the next. Think of it like a gold rush, because the pattern is over a century old and it repeats every single time. First, money flows to the miners, the ones digging for gold. Then everyone realizes the miners can't work without shovels and picks, so money floods to the tool sellers. Then the mining towns run out of places to sleep, so money flows into hotels and land. Then the towns need water, food, transport, so money flows there. Every stage looks obvious in hindsight, and every stage feels invisible while it's happening, because everyone's still staring at the previous winner. Now let's map that onto AI stage by stage with real numbers. Stage 1 was the brains, the GPU chips themselves. That was NVIDIA's era, and it was breathtaking. The company delivered around $216 billion in revenue in its last fiscal year, up 65%, with roughly $1 trillion in confirmed chip demand through 2027. If you caught that early, congratulations, but the easy part of that trade is behind us. The whole world knows about NVIDIA now. Stage 2 was the memory feeding those brains, and that's the stage Micron just delivered. The bottleneck shifted from can we get chips to can we feed the chips data fast enough? And the 3 companies that could solve it got repriced violently upward. Hard drive makers Seagate and Western Digital are each up around 180% this year. And NAND flash makers have seen prices accelerate so fast that incremental gross margins hit 100%. Every extra dollar of revenue was pure profit. That stage isn't a secret anymore either. Which brings us to the question you actually clicked on: where does the money flow next? Here's the stat that unlocks everything, and honestly, when I first saw it, I had to read it twice. The 5 biggest tech companies, Amazon, Alphabet, Microsoft, Meta, and Oracle are guiding toward a combined $635 to $690 billion of capital spending in 2026 alone. Amazon by itself is projecting $200 billion. But here's the part almost nobody is thinking about. According to industry analysis, only about 25% of that spending goes to chips. The other 75% goes to physical infrastructure, data centers, power systems, cooling, networking, and land. Read that again. For every dollar going into the chips everyone's obsessing over, roughly $3 are going into the boring physical stuff nobody's talking about at dinner parties. That's the map. So let's walk through the next bottlenecks one by one. Bottleneck 1. Electricity. This might be the biggest one of all. Data centers currently consume around 6% of all U.S. electricity, and that's projected to nearly double to 11% by 2030. Goldman Sachs now expects global data center power demand to grow 220% from 2023 levels. The AI race is quietly becoming a race for electricity, not chips. That's why power producers, grid equipment companies, and nuclear energy names have been some of the market's best performers. A fuel cell company was literally one of the top 5 stocks in the entire market this year, up nearly 200%, and it's not even a tech company. Bottleneck 2. Networking, the nervous system connecting all these chips together. When you stack hundreds of thousands of GPUs into one cluster, the wiring between them becomes the constraint. Custom AI chips are projected to grow at nearly triple the rate of standard GPUs, and 2 companies, Broadcom and Marvell, control roughly 95% of that custom chip co-design market. NVIDIA's own CEO recently called Marvell the next trillion-dollar company, and the stock jumped 33% in a single day on that comment. Smaller connectivity players are growing even faster. One networking chip company just reported revenue up 157% year over year. Bottleneck 3. The physical shell, cooling systems, data center real estate, construction, land with grid access. AI racks run so hot that traditional air cooling literally cannot keep up, forcing a shift to liquid cooling, an entirely new equipment category. And data center land with existing power connections has become so scarce that even Bitcoin mining companies are being bought up, not for their Bitcoin, but because they already own buildings connected to huge amounts of power. Now, before you sprint off to buy all of these, stop, because this is where the psychology lesson comes in, and it's the part that will actually save you money. Every stage of a build-out follows the same emotional arc. Early, the opportunity is invisible and feels boring. Middle, the numbers start showing up and it feels uncertain. Late, it's on the front page and it feels safe. And here's the cruel joke of markets. The moment it feels safest is precisely when most of the returns are already gone. Micron felt risky at $100, it feels safe at $1 trillion valuation, and that feeling is exactly backwards. So am I telling you Micron is finished? No, and be careful here because sold-out capacity through 2026 is real revenue visibility, and some analysts still have aggressive price targets on it. But understand what you'd be buying. Memory has been a boom-and-bust industry for its entire existence. When prices peak, competitors add capacity within 12 to 18 months, and the cycle turns. The investors who ignore the cycle, as one analyst put it, pay for it later. Buying stage 2 after its 700% move is a fundamentally different bet than buying it before. You're no longer being paid for seeing something early, you're paying a premium for what everyone already sees. There's one more risk I need you to hear, because I'd be lying if I skipped it. Roughly 40% of professional fund managers now say AI stocks are in a bubble. The counterargument is real too. Unlike the dot-com era, this build-out is being funded mostly with cash from wildly profitable companies, not debt. But when this much money moves this fast, corrections are not a possibility. They're a guarantee. Broadcom dropped 15% in a single day recently just for reporting slightly soft revenue. That's the kind of volatility you sign up for in this theme, even in the winners. So here's your actionable playbook. 5 steps. Step 1, stop asking which stock do I buy, and start asking which bottleneck comes next. That one mental shift puts you ahead of 90% of retail investors. Step 2, follow the capital expenditure numbers. Hyperscaler spending guidance is published every quarter in earnings calls. It's free, and it tells you exactly where hundreds of billions of dollars are headed next. Step 3, if picking individual bottleneck winners feels overwhelming, that's what sector funds are for. There are ETFs covering semiconductors, grid infrastructure, and data center themes that spread your bet across a whole stage instead of one company. Step 4. Position sizing is your survival tool. No single AI theme stock should be a bet you can't afford to watch drop 40%, because at some point it will. And step 5. Write down your thesis before you buy. One sentence. I'm buying this because the specific bottleneck is unsolved. So that when the headlines get scary, you can check whether your reason still exists instead of panic selling at the bottom. Look, here's the truth underneath this whole video. The people who made life-changing money on Nvidia weren't geniuses, and the ones who caught Micron early weren't lucky. They just looked one step ahead on a map that was sitting in plain sight, in earnings calls, in CAPEX guidance, in supply chain reports, while everyone else stared at yesterday's chart feeling regret. The regret you felt about missing Micron, you have a choice about what to do with it. You can let it push you into chasing the last trade, which is how regret compounds. Or you can let it teach you to finally look forward, which is how wealth compounds. The build-out is not over, the hyperscalers just raised their spending plans again, and the next bottleneck is forming right now in power lines and cooling systems and networking racks, while the crowd is still busy celebrating the memory trade. So tonight, do one thing. Pick one bottleneck from this video, power, networking, or physical infrastructure, and spend 30 minutes researching it. Not to buy tomorrow, but to understand it before it's on the front page. Because the goal was never to catch Micron. The goal is to make sure that a year from now, you're not watching another chart, feeling that same hollow feeling, saying, I knew about this one too.